Morning, everyone, or depending on your time zone. Welcome to this webinar. We're just going to give it a few minutes just for other people to join before we officially start. Okay, welcome everyone to this webinar on assuring plant materials and equipment costs under NEC4 contracts. Just a few notes, I guess, before we begin officially. If you have any questions at any point, please feel free to ask them in the Q&A box that you see on the bottom there. These will be picked up in the last sort of 5 to 10 minutes of the webinar. And if we get time, we'll try and answer as many of those as we can. And if there are some important questions that we are not able to get to at the time, we might leave a note alongside the slides and the recording, which will be shared after or a few days after the event. Before I hand over to Ian Heaphy and Darren Ward, I'd just like to thank the Orange Partnership for helping to deliver today's webinar and session. I'll hand over to Ian Heaphy.
Thanks, Farhan. Welcome, everybody, wherever in the world you may be. Welcome to this webinar. This builds on a previous webinar that Darren and I gave some time ago in regard to people costs. Today, as has been highlighted, we're looking at plant and materials and equipment and how we validate and evidence those costs. So we'll do some very quick introductions. I'll then talk through the contract requirements. Then Darren will dig into the detail of how you undertake that assurance. And then we'll leave some time for questions at the end. So by way of my introduction, I'm Ian Heaphy. I'm a member of the NEC4 contract board. So I've been involved in drafting the 4th edition of the NEC contracts and continue to be involved in revising, updating and producing new contracts, new editions, and also producing supporting documentation. And I work in the UK and internationally, helping clients, contractors, consultants adopt and get the best out of NEC contracts. Darren?
Morning, everyone. I'm Darren Ward, Managing Director of the Orange Partnership, been there for 20 odd years. I'm a qualified chartered accountant, ex-Big 4, KPMG. And for my sins, spent the last 30 years in and around open book contracts, probably personally delivered 500-600 and been involved in probably nearer 2,000 audits or inspections from an open book audit perspective. That's me.
Okay, great. Thanks, Darren. So by way of introduction to the session, we're going to go through a little bit around how the contract operates, the key clauses and provisions we need to be aware of before we then get into the actual audit regime itself. So first thing to pick up on is that we are going to use the NEC4 ECC, the engineering and construction contract, as an example. It's probably the most commonly used form of NEC contract, one which many of you may be familiar with, that probably has one of the more complex schedules of cost components and features things like plant and materials and equipment. Do be aware, though, that there are other NEC4 contracts that have cost reimbursable payment options where similar issues and themes may arise. So the professional service contract, term service contract, facilities management contract, the alliance contract, and also the design, build and operate contract. Obviously, important to note that in contracts like the professional service contract, you're not going to have plant and materials and equipment of the same nature as a construction contract or a FM contract, but still principles and themes are consistent across the contracts. Looking to the NEC4 ECC, this engineering and construction contract, we have within that contract 6 main options, and the client will select one of these main options when they put the contract together. And options C, D, E, and F are based on cost reimbursable payment, the contractor being paid their actual cost, or what in the NEC world we call their defined cost plus a fee. And it's those contracts we're going to concentrate on, primarily options C, D, and E, and use those as the basis for today's discussion. But just do be aware that defined cost is a feature of all of these contracts when we assess the costs of compensation events. And so again, some of the themes and principles will be applicable across all of those main options. So looking at these options C, D, and E, within these contracts or within these main options of the ECC contract, we have a definition of defined cost being a defined term, and it is the cost of the components in the schedule of cost components less disallowed cost. So breaking that down, firstly, the schedule of cost components is a part of the contract that provides a detailed listing of what costs form part of defined cost, and anything that falls outside of that definition is deemed to be covered by the fee. So it's like a detailed document expressing with quite a level of granularity what costs are payable as defined costs, anything outside of that deemed to be covered by the contractor's tendered fee percentage. The schedule of cost components also has a little preamble to it that confirms that cost must be incurred in order to provide the works. There's an evidential requirement there that the costs have been incurred in providing the works under this particular contract. And as I think you would commonly expect, costs can only be claimed once under a single cost component. So when we look at defined cost, there is a clause in the contract, clause 52.1, that provides some guidance around how we treat defined cost and how we determine the fee. So the first thing to highlight, as I've already mentioned, is that any of the contractor's costs that they may incur in undertaking the project, in running and managing their business, is deemed to be covered by the fee if it's not, or if it doesn't fall within the definition of defined cost. So we don't define what's in the fee. Any of the contractor's costs that do not fall within the definition of defined cost are deemed to be covered by the fee. So there should never be any arguments. Is this cost in the fee? Is it in defined cost? If it doesn't fall within the definition of defined cost, it's deemed to be covered by the fee, whether the contractor realised that at tender stage or not. So important to understand that definition of defined cost. Also, clause 52.1 states that amounts are only included in defined cost if they've been calculated in a particular way. So firstly, where we have any rates and percentages stated in contract data part 2, so in effect pre-agreed at tender stage by incorporation into the contract as part of contract data part 2, those rates and percentages must be used. So in that case, we don't use actual cost, we use pre-agreed rates and percentages for those limited items pre-agreed and identified in contract data part 2. For all other amounts of defined cost, the majority of it, so things like subcontractor costs, things like charges, as well as plant and materials and equipment, those are at open market or competitively tendered prices, with deductions for all discounts, rebates and taxes, which can be recovered. So we're looking at true actual cost as evidenced by the contractor's accounts and records, and that has to be at what is considered an open market or competitively tendered price. And Darren will pick up on this in more detail later, but one way for a contractor to demonstrate it's an open market price is to go through a competitive tender process and to actually show they've been out to 2 or 3 different suppliers. They've got 2 or 3 quotations for the cost of the plant and materials, for example, some concrete, some steel, and they can demonstrate that the price that the contractor is going to use is going to represent an open market price because it was sourced through a competitive tender process. That doesn't mean the contractor has to go for the lowest price. Often there can be a balance of quality as well as cost, and maybe for higher productivity equipment with less breakdowns or additional, services or support, it may be that a higher price is reasonable to be charged, and it still represents a competitive or open market price. You may also get situations where the contractor single sources plant and materials or equipment. And in that case, the contractor is still required to demonstrate it's an open market price, that it in effect represents value for money. And that may be by benchmarking, looking to other contracts, maybe members of the client's team, including the auditors, checking out what the market rate is for similar items or products, to enable that comparison and that decision to be made. So just in terms of what we're talking about when we say equipment and plant and materials, they are both defined terms within the contract. So equipment is items provided and used by the contractor to provide the works, and which the scope does not require the contractor to then include within the finished asset, the final works. So this would be things such as construction equipment, excavators, cranes, JCBs, generators. It's also going to cover for temporary works, scaffolding, site fencing and hoardings. It's going to be site cabins, temporary haul roads and footbridges. And it also covers consumables, things like welding rods and fuel that is consumed in the course of providing the works. Plant and materials, they're different, they're separate. Those are things to be incorporated into the works. So that's your steel, your concrete, your rebar, your timber, the things that actually are built into the asset that is being constructed. So those are the terminology you need to be aware of. Slightly different to maybe common construction terminology. People often refer to contractor's plant. In NEC, that would be equipment. Plant and materials would be like heating and ventilation plant, as well as other materials to be incorporated into the works themselves. A couple of other points of note. Subcontractors and their equipment and plants and materials are a different cost component. So subcontractors, amounts paid to subcontractors, and ultimately by that subcontractor to their supply chain are dealt with under cost component 4. And unless included in any equipment hire rates, the cost of operatives operating the machinery is included in cost component 1, people. One other thing to be aware of when it comes to equipment is that it needs to be used within the working areas. And the working areas are the site and any designated areas that are necessary for providing the works and used only for work in the contract. And it's the contractor who will propose those working areas outside of the site. When it comes to equipment, we need to work out who owns the equipment to determine how that is paid for under the schedule of cost components. If the equipment is externally hired, so from a company separate to the contractor or the contractor's ultimate holding company, a sister company, or a company in the same entity, the contractor can recover the actual hire or rental cost they pay. If the equipment owns some equipment, if the contractor owns some equipment itself, that will be paid for based on an open market rate, so the equivalent of an external hire rate. For equipment which is purchased, the contractor will recover a depreciation cost, so purchase cost less residual value, plus a time-related on-cost charge stated in contract data part 2. Sometimes the contractor may have very specialist equipment, maybe diaphragm walling equipment, something you can't hire on the open market. It's hard to get benchmark rates for, so that will be paid for using pre-agreed rates in contract data part 2, so rates agreed at tender stage and included in the contract. And then finally, for equipment which is consumed, the client will pay the contractor the purchase cost, what the contractor actually paid for their fuel, their welding rods, etc., on an actual cost basis. In terms of plant and materials, this is a lot simpler in terms of how it's dealt with. Basically, the client will pay the contractor the amount the contractor pays to their suppliers for the cost of the supplier providing that plant and materials. In addition, the contractor can recover the cost of delivery to and removal from the working area, providing and removing any packaging, samples and tests that may be required. And if we find out at some point that we have over-ordered materials, or maybe there's been a need to restock materials because of a change in scope, meaning that plant and materials are no longer needed, any costs the contractor recovers from the disposal of excess plant and materials is credited back to the contract. And then just touch on disallowed cost very briefly. This is also a defined term. There are a number of items identified as disallowed cost. We've picked out a few here as examples that are pertinent to plant and materials and equipment. So you would disallow, as the project manager, costs that are not justified by the contractor's accounts and records. And that's a key topic Darren's going to speak about. Also, the cost of plant and materials not used to provide the works. So things ordered in excess, not plant and materials that were actually needed, but we do have to allow for reasonable wastage. And also a disallowed cost would be the cost of resources not used to provide for the works. So resources such as maybe a tower crane, it's needed for a few months on the job, it's no longer required, it should be off-hired, it should no longer be charged as part of defined cost. If it is, that cost could be disallowed. Though we do have to take into account reasonable availability and utilization and recognize that many of these pieces of equipment won't be operating 100% of the time. There will be non-working periods, but it may not be sensible to off-hire those pieces of equipment because it's going to take more time, cost more to then remobilize them later. Okay, Darren, over to you.
Thanks, Ian. Really useful introduction there from Ian on some of the sort of contract rules around plant material and equipment. The next 40 minutes or so, I'm going to go through a little bit more detail on actually doing inspections and audits. So for anyone who knows me, 40 minutes without sneezing will be a rare feat. So please do expect 2 or 3 interludes with me my tissue to my nose, I will apologise. Anyway, so we're going to go through this this list here. One thing I would recommend to anyone doing audits and inspections is to have a read of Managing Reality. There is a good section in there that does talk through how to go about audits and inspections. So of the areas I'm going to go through, first thing is why. So why is it so important that we inspect records? Well, it's pretty obvious. We have to pay what is contractually correct. And at the heart of this is defined cost. Now, perfect world would be that every contractor application for payment is supported by a defined cost that is both accurate, transparent, and well controlled. So that's the holy grail, a right first time application. So sitting behind that would be really good open book principles that the contractor uses. But the journey we're on today, and we've only got 40 minutes or so, is for me to provide you, whatever role you're in, project manager, cost manager, auditor, or contractor, just a little bit of more awareness, increase your awareness on plant, material, such that you can conduct further investigations in the future. Now, it doesn't matter where you sit here, what side of the fence. My view is there shouldn't be any games when it comes to assurance work. We want to gain confidence in defined cost, and we want to gain confidence really quickly. However, what's super important here with plant and material and equipment is it's slightly different compared to other cost components, because we can often be looking at a high volume of low value transactions. Yeah, and if we're going to get through a lot of data, we need to be very considered in how we go through our inspections. So we'll come on to that further. My slides have got a little slide section on the right with a light bulb. That's a few tips. What am I really saying on this slide is a bit of a learning point. First and most important is never leave inspections or audits to the end. I see it way too often with project managers or cost managers on their behalf paying things on account. It's way better to start early and do less towards the end than the other way round. The perfect world where inspections is concerned would be to have a solid 3 lines of defense. What does that mean? Well, line 1, come back to the first bullet. We want a contractor who comes with good, accurate, transparent, and well-controlled defined cost. It is not a given. Some contractors are better at open book than others. Yeah, but that's what you ideally want. We want a good line 2, which is the project manager or their cost manager doing regular inspections, a part of their assessment work. And as I said, not leaving things to the end. And line 3, more relevant on perhaps complex or large value projects or programs, you want an independent auditor who can come in and look at additional areas and provide additional comfort. So any contract may be amended, and in particular we're going to talk here about plant, material and equipment, but just a quick recap on why people amend contracts. We have to remember, in the defined cost world, we often see the client or employer taking the risk in the financial outturn from a cost perspective. So I accept there will be some pain gain protection in target scenarios, but what we often see is clients who have suppliers that they need to look after the money as if it was their own. So as a result, we often see increased values of contracts demand increased expectations on charging rules and record requirements. Therefore, as a result, the client or employer would turn to the scope or Z clause to amend. Yeah, so a little tip here. When you do amend, please be practical in what you add to scope and Z clause. Yeah, What we see a lot of is we see the standard NEC wording where the project manager is allowed to inspect. We see this replaced by the contractor being forced to supply a list of accounts and records each month. Now, this has never been the intent of the NEC. It shouldn't be that we inspect and audit 100% of records. Yeah, it is going on in the industry. It's not clever. It's very inefficient and it's incredibly costly. And we'll explain a bit more today with some examples why that might be the case. So when it comes to plant and material and equipment, do we see much in the way of amendments? Well, plant and materials, not really. Equipment, occasionally on the bigger projects. What kind of amendments might we see? So Ian's mentioned the reference to open market rates. So that may be fleshed out a little bit more in the contract. It might state we expect a minimum number of quotes or prices from suppliers. We might introduce more formal tender requirements such that above a minimum value, you must seek X prices, 3, 4, 5 prices from competitors. Yeah, that can apply to plant and materials clearly too. It's not uncommon to have specific hire versus buy requirements in relation to equipment to help drive value for money. Also, more and more common is the use of other reports or evidence to support utilization. So, for example, specifying telematics reports. We've talked about intercompany equipment. We'll come on to that. But again, there's often an extra rule clarification perhaps added about using associated companies and potentially fee on fee. One amendment we do see is where we see those cost components 21 and 22 that Ian's just mentioned. We see them actually overridden by the use of some kind of industry recognised price list. So, for example, in the UK, we often see a reference to seeker rates in contract data. So what's the tip or learning here? Yeah, some of these amendments, they may be excellent suggestions on bigger projects, but not always. My view, evidence and equipment productivity is always beneficial for both sides to see how much equipment is really being utilised. Can it be on, off hired, etc. And can be seen as a very much an effective sort of anti-fraud measure. However, in all this, if we amend rules, the most important thing is read your contract. Know what those rules are before you start any form of inspection. So I mentioned it on the last slide that sometimes that we see rates used for equipment in lieu of 21 and 22. So what we might commonly see in contract data part 2 is a set of equipment rates inserted. They could be based on a seeker percentage, or they could be internal rates from an internal hire company within the company's group. So with all rate mechanisms, there's pros and cons. So what are the pros of using equipment rates? We all know it's simple. All you're doing is applying a rate by the unit, whether that's an hour, day, week. The rates are there in contract data for everyone to see. It overrides the need to agree open market rates on the vast volume of equipment. That's particularly good if you're using some kind of index like Seeker that's got good coverage. It automatically overrides any internal company fee on fee or cross-hire issues. And the other thing, it can be really good from a value for money point of view, because you can evaluate this at tender stage. You can align your bidders, see where they all sit. They may be bidding at a percentage up or below the standard seeker rates. What are the cons? Well, like any time we use rates with NEC, you may not get full coverage on the equipment type actually deployed on your contract. So then what? We would need to think about inflation. What if there's if we've got long duration projects, what period do the rates cover? Another one people sometimes forget is how complex it can be for contractors to produce an application for payment, because they're taking the actual quantities of equipment in the month out of the accounts ledger or the equipment ledger module, and they've got to look the rate up against your contract data pre-agreed rates. It can be time consuming. And therein lies another problem. We often see contractors still leave their ledger costs in there as part of the wider support for the application for payment. So the true internal costs that are there to be seen, whether it's based on supplier third-party invoices or internal plant hire charges, equipment hire charges, which may be different to what the contract data rates show, i.e. there can be an over or under recovery in this scenario for one party. So if we're going to use rates for equipment and put them in contract data part 2, the best thing to do is request as part of your tender stage while the bidders can compete and give you best value equipment rates. And secondly, as with all rates that go into contract data part 2, expect time charging clarifications. You know, we may need to make things really clear here, whether we're talking about hire per hour, day, week, including, excluding fuel, transport, maintenance, etc. So that seeker example was not the standard, but what is? So clause 22, component 22 of the schedule of cost components is about open market rates. Ian touched on this earlier, and here's just a visual example. So we've got a scenario here. We've gone into contract with contractor X, and contractor X wants to use its own internal equipment supplier. Now, because that supplier needs to supply at open market rates, contractor X needs to do an exercise. And the exercise is that they've gone to 3 local hire companies in November 22. And as you can see on the top row for this particular piece of equipment, they've ended up with 3 quotes, 701 to 1306, and an average of 958. So typically, what is the open market rate that contractor X can charge when it supplies something from its internal equipment hire company? Well, the aim is to price what the market will offer at that point of time. That's assuming that all these 3 suppliers can honour that order. And we need to have, obviously, quality, delivery aspects, like for like. So here, lowest seems reasonable. So we would expect contractor X to charge £701 for this equipment rate in November 22. However, if the supplier, the contractor X, is providing equipment for a longer duration on this project, we may need to go back and do periodic checks, drop back in June 23, November 24, example, because the volume or type of equipment might have changed significantly, as may the market. Now, the contentious thing here is that contractor X may actually have an internal company rate of £605 per unit for this piece of equipment. But we've agreed a market rate of £701. So in this example, we don't even get to see or hear about the £650. Yeah, the way it works is all the contractor X has to do is demonstrate an open market rate. So some people don't like this. Some people want the contractor X to honour their internal company rates, specifically if they are cheaper than what the open market is deemed to supply. So if you want to get into this scenario, it's really important that you pay the £650 through a pre-agreed rate, which again needs to be flipped into the contract data, part 2, pre-contract. So it can be a somewhat contentious area, this one. So When we start inspecting now, we're talking about getting into actually verifying cost data. How do we start? Well, the one thing that I don't like to see is people just dive into AFP data. So I think it's super important that before you start your inspections or audits, you start to understand the control environment about how the cost is actually incurred and managed. So we've done a bit of pre-work, we understand our contract, we may have even had a high-level review of our application for payment. We've got a feel for cost data, what it looks like by supplier, item, day, month, cost, etc. But we need to see the site, go and see the project in practice. Get out, speak to people. Go and speak to the equipment yard manager. Visually see how equipment comes in, goes out, where it's stored. Similarly, plant and materials, the ordering system, where things are checked over, where things are stored. Great insights can be provided around from contractor staff. Find out what information and reports they use day in, day out to manage cost. This could be much more important and useful information than what actually sits supporting the month-end AFP. Speak to finance staff at head office. See what additional data or reports they produce. In essence, does your contractor have a good first line of defence? So tips here, seek out the key controls that you can rely on from your contractor and what checks and balances occur day in, day out, week in, week out. See what is evidenced and start to build that understanding of whether your contractor at first line produces a right first time application for payment. And again, note down what additional day-to-day, additional reports or tools help manage plant, material and equipment costs, because these could be built in to your data sets further on when you do your audits. What do I then do? Do a little bit of a recap on the control environment. I've had a look at the contract, I've walked the site, I've had a high-level view of the AFP, I've looked at the day-to-day operations and controls in relation to the costs. Scribble it down, get a whiteboard out. I start to visualize how things move in and around the site. I then have a quick chat with a colleague, explain to them what I've seen. Does it seem logical? Is it good control? Start to think about what could go wrong. At this stage, you're trying to identify if anything is awry. Is there any obvious mischarging risks? And again, I do all this pre-inspection. So where are we at industry-wide? We are in an industry that is in danger of over-auditing and inspecting, and we're not doing it in the right areas either. We spend too much time repeating samples and invoice checks month in, month out. I'm going to provide a good example in a second regarding some porter cabins to show this. So I've talked about data, not wanting to throw ourselves into data, but here I am throwing ourselves into data. Yeah. So what have I got on screen here? I've got a typical data dump from a contract cost ledger report. It's what everyone gets to see month in, month out, typically. It doesn't matter what system you're on, Oracle, SAP, Coin, Sage, they all look broadly the same. So we might get an application for payment in the month with £1 million cumulative value for equipment. And that £1 million of cumulative value for equipment would be the summation of column 9 on this spreadsheet. Yeah, thousands of rows adding up to £1 million of equipment. And this is where the problem lies in the industry. People just want to highlight rows. I'm going to take every 5th transaction. I'm going to take all transactions. I'm going to look at round sum amounts. I'm just going to look at high value amounts. It is not intelligent. So what is super important about cost data? First thing is understand it. When I go left to right on these columns, there will be loads of people who simply do not understand what some of the key columns equal. As an example, columns 6 and 7, ledger and type, they can reveal how the transaction has entered the contract cost ledger system. A traditional plant material equipment item probably comes off a PL, purchase ledger, and a PM, purchase invoice type. However, something that's GL and JLN is something from the general ledger and is a journal, and that is a more risky or potentially forced transaction. It could be an allocation or a recharge from another contract. So again, really important to understand your columns. And the one thing to say on this is, whatever data set you get given is not the best data set that you can work with. Yeah, so the opportunity is to develop better data sets with your contractor. And lastly, as I say, highlighting row after row for inspection is simply not smart, but as appears to be the go-to approach in our industry. Really busy slide here, so I'm going to go through this as quick as I can. Just picture the accommodation unit on its own, top left. You hire that £60 to £100 a week. You turn it into an accommodation block, 48 of those. On the right-hand side photo, you're going to get a better deal. So we've got that now at £50 a week. This, just to put into perspective, is a real-life example. The porter cabin on the right, we've used on a 4-year program. So the cost of that for those 48 units at £50 a week is £2,400 a week in total, £124,800 a year, and across the 4-year program, £499,000, £200. Right, what have we seen in the contract cost ledger, the data supporting the AFP? Well, believe it or not, we've seen 48 weekly costed rows at £50 for 52 weeks a year for 4 years, plus 96 month-end accruals in and out reversing for the full 48 months. That equals 14,592 records we observed in this cost ledger supporting a claim for £499,200. I've used this example in many commercial meetings, workshops, etc. And to a floor of people, I've said, right, of those 14,592 records, how many would you inspect? I've had responses from 100% to 10%. I then asked, what would you ask for? The purchase order, the delivery note, the invoice, the proof of payment. I get lots of blank faces, and that's because there is so little assurance, inspection, audit guidance across the industry. When someone said to me 10%, I said, why? And they go, well, that was what I learned on my first job for Bob, who sat next to me. I asked someone else, why 100%? Oh, that was on an audit guide I had from the previous project I worked on. None of these people are using their common sense. So I go over to the pink box on the right-hand side. Let's think about it in a bit more depth. We know the porter cabin, the 48 units, has been competitively tendered. We struck a good deal at £50 a week for 4 years. We know the data, although it's high in volume, it's transparent. We see the descriptions of all the units being charged. We know the name of the same supplier. The data is consistent, the same value and volume every week, every month. The equipment's physically known. The auditor inspector in question actually sat in this building for 4 years. The budget for the actual build was £500,000. In the original budget, accommodation cost was £500,000. This is now an incredibly low risk transaction. So I asked the audience again, 14,592 records, how many would you actually inspect? The answer suddenly comes back. Someone brave enough, I don't think I'd bother inspecting any at all. So probably not quite the right answer, but it's someone using their common sense, and they're using intelligence other than the basic cost data to check the volume and value of samples they need to go and inspect. The interesting bit on the bottom of this slide is the bit in bold, because on a different project with a different contractor who's got a different accounting system and a different supplier providing the accommodation, we actually would have ended up, and that's a typo, it should be 48 rows. We ended up with 48 rows of data. It was one invoice per month at £9,600, 48 rows. But that's 48 rows compared to 14,592 on what is effectively the same situation, really, from a risk perspective. So we've touched on accounting data and what's in supporting the AFP. And I'll just go back. Remember, we looked at this one. So you've got your accounting data there. What's really important is that we start to build better data, because often the data that supports an application is somewhat user or audit unfriendly. Yes, it may demonstrate a cost, but it doesn't help inspections. And why might that be? The data, it might be difficult to fully identify plant and material descriptions or quants. It may not reference GRN, PO information. It may give poor visibility of things like accruals. It may not give invoice paid dates. It may lack for equipment on/off hire dates. It may not show whether the equipment is internally owned or cross-hired. It may give poor visibility on asset types, you know, IDs, numbers, reg plates, etc. Even the date information is limited. You've got it in that XXXX format. You need to split it into years and months. However, the tip here is what? Your supplier or contractor does what it does at the end of each month end. It's working for multiple clients on open book arrangements. Therefore, it produces applications for payment from its standard internal accounting systems. So your contractor is not being awkward if that data set doesn't align easily to the contract or give the detail that you might expect, or what you've seen on your last job with a different contractor. So important here, always work with your contractor in the early days, not against them, to get the extra granularity required in the cost data. You know, examples being plant location, material order analysis reports can typically help. And I come back, key to that is those discussions early doors when you visited site or spoke to head office finance. All this is allowing you to build much better data sets, and good data allows you to visualize data better. We need to bring data to life, and from that, we can ultimately sample and inspect better. The one thing I would say is on all this is don't just think of accounting data as your friend. There's a lot of good site records that can support your analysis for inspections. I've mentioned equipment reports, telematics, timesheet information for labour, site diaries, programs, as-built, etc. So always be sensible and think why that data has been produced for site purposes. It's clearly relevant, yeah, helps validate how the work's been provided and can be useful when you start to do your accounting inspections. So now, visualizing and interrogating the data. So we built a good data set. You've got to start to analyze it really thoroughly. So some simple things to do. Analyze plant and material and equipment by description. Analyze it over time by cost or quantity, per day, per week, per month. Typically, equipment always good to use on a monthly basis. Look at the ins and outs. Understand posting patterns. It's not uncommon if you've got, I've seen it, 70, 80,000 rows of costs. You might have 10,000 of rows of those that actually contra each other off to zero, in and out accruals. So suddenly you can remove 10, 15, 20% of your cost data if you understand it better, because it has zero impact on the cost. You look for periods that look unusual, and you start to then think, does all this cost data hang together? Speak with project managers, works managers, How does it align to budgets, forecasts, programs, etc.? And in building this data analysis, what do you need? You need some basic Excel skills, know how to do a pivot table. And then what you start to do is develop a core set of tables or graphs that you can visualize on your project. That will always give you a really strong 80-20 feel for where the money is spent and make sure the inspections and audits you do are cost effective and focused. I'm now going to share a few examples of what good data sets can do in terms of bringing data to life and helping with your inspections. So here's a really simple example. We just looked at equipment by type in this one. So on the bottom axis, we've got 5 types of equipment from tower cranes to digital radios. On the top half of the table, we've graphed what the values are and stacked one on top of the other. This is really simple stuff, but it brings Excel data to life. What it shows is that we've actually got 1.18 million of equipment costs supported by 527 rows of cost. And the simple stacked graph here shows where the focus needs to be. It's the circle data. So we've got 95% of the cost sitting with a handful of transactions on tower cranes and accommodation. And that's where you want to be spending your time doing your audits and inspections. You do not want to be auditing 155 records for digital radios, which in total add to £5,333. It's ludicrous, yeah? So again, good data sets equals good visualization, helps you sample. Another one, in terms of looking at equipment cost by type and volume. So I'm not discounting the previous slide of looking at low value equipment, because this is a good example that shows some issues. So what we've got here is we've got a number of small value items. We've looked at the quantity of hires. So what does it show? Look at the pink box. We've got 11,000 individual weekly hires of cordless drills at £20 a week. So on this project, we've spent £220,000 on cordless drills. Now, if on this particular project, which there was a Z clause talking about hire versus buy decisions, you can clearly see there's a massive value for money challenge as to whether hiring these cordless drills provided best value for the client, because they clearly would have been better to use them and dispose of them when they broke or finished their life. Another one, again, very simple. This is just van hires where we've brought in another data set. So we've not analysed equipment on its own. We've brought in a comparison with labour. So a complementary data set. Your van hire costs is the orange line. The blue columns is your labour cost. So the first little squiggle or bubble in July 22 shows that we have vans on hire and on site and no labour. The issue repeats X weeks later. And this was an issue at the end because this was the tail of the project. So we kept too much vans on hire when there was no labour. So it clearly showed a concern of slow off hire. Moving on to materials. We've got materials whereby here we've shown the materials, a type 1 material being delivered on a project per day of the week. So we can see Monday, 4,000 tonnes, 200 deliveries. What we found here was that we had deliveries on a Saturday. Yet strangely, this particular project, the site was closed on a Saturday. And that come from our earlier inspections, pre-inspections when we'd walked the job. So what was the root cause of this? We investigated it and found that goods received notes were processed for a close by project on a Saturday morning. And the person doing that processing was actually a person who was doing overtime. So it was a materials controller working on project 1, Monday to Friday, doing a bit of an overtime on a second project on a Saturday. And internal finance incorrectly thought that resource was 100% dedicated to project 1 and assumed all deliveries associated with that individual were too. So project 1 incorrectly got mischarged project 2's costs. Another one on materials. If you've ever looked at Benford's law, this shows the expectation on patterns of numbers. And we looked at a load of materials here. And what we found on this particular data set of thousands of transactions, we found that 67% of all material costs started with the number 5. Benford's law would suggest that's only 8% of transactions. So on further investigation, what was it? We found that actually on this particular project, stock was being issued from a store cupboard at a standard price of £50 a unit, hence the high volume of 5s. This warranted further investigation, and under inspection and audit, we found that the average cost of every item that actually left the store was £23. It was a mischarge of £27 a unit. Final couple of slides now. Again, building data sets. If you start to build in with your data set the actual paid date of every invoice, you can start to see what the actual payment date analysis is. So in this graph, on the bottom row, we've got a number of suppliers and what the spend with those suppliers is. What we was actually able to do by lifting the actual invoice paid date against the invoice was to prove that on this particular arrangement, the contractor was taking over 80 days to pay its supply chain and was therefore cash flow and gaming against the client or employer, going against all the rules of price for work done to date, etc. So just coming to the end there, there's some good examples of how you can build big data sets, graph it, and that will really steer how you are much more effective in the volume of samples that you look to inspect. When you inspect them samples, always do good practice of writing down results, keep on top of when things aren't supported from the supplier, ask why. They give you an invoice that doesn't agree to what the cost is you've asked for. Understand what it is. Don't jump to the wrong conclusion. You may have missed something. And root cause understanding is always key. And it's much better to work with your contractor than simply disallow. Remember, all your samples need to be indicative of wider populations. That will allow you to draw sensible conclusions. You want to record your tests in detail, make evidence of what you've done. Far too often do I see audits being done first, second, third times because people have poorly recorded what they've looked at, what they're comfortable with, and what they're happy to be closed out. And this really does impact the ability for successful clause 50.9 closeout. So in conclusion, start early, get involved in those inspections early. Much better to gain the confidence that things are correct, and you can test less towards the end. Pretty much last slide now. Disallowed costs. Do we see much disallowed costs in plant, material and equipment? First one I just want to mention, rebates and discounts. It's not as such a disallowed cost, it's just something we don't see credited well enough or often enough into contract cost ledgers. The only way you really get to the bottom of this is go and spend some time with head office procurement to see which suppliers they truly have rebate or discount arrangements with. Some of that information may not sit with site commercial teams. On lots of projects, as we get towards the end, we see late accruals and provisions hanging around that contractors continually wish to charge. So again, make sure that you see full proof back to accounts and records of invoice and payment. For equipment, there will always be small value items, costs of repairs, damages, lost and stolen items that potentially shouldn't be claimed and are disallowed. We see duplicates between manual spreadsheets and the core data in the application for payment. often in the area again of accruals. You may see operative charges twice as a person people cost, hands and equipment hire cost. And finally, you may get rates that we've mentioned before, not open market, fee on fee issues. And I've been through some of the examples of hire versus buy, wastage, etc. So lots of areas to look into. Again, I come back to it. Many relate to high volume, low value transactions. Remain focused in your audit inspection work. And remember, the cost of investigating or inspecting may cost you more than the value you actually disallow. So final summary, go back to the start. If you're going to amend in Z clauses and scope, adding in rules and accounts and records requirements, be pragmatic. There's a huge importance of visualizing activities out on site to understand how plant material and equipment are controlled. Once you get into your inspections, first and foremost, understand your rules, your contracts, super key. Secondly, look at what you've got in that contract data around rates, because that route may well be chosen. Talked about the risk of open market in internal companies. Then it's into the work itself. Build the best data sets you can, visualize the data, get out there, do your specific and focused samples. Don't go for the 100%, 10%. It doesn't add value. And most importantly, at the end, write up, report what you've done, and keep good records to avoid future replication of audits or get yourself all in good shape for a clause 50.9. So apologies, I've talked too long. Sorry, Ian talked too long for 5 minutes too much at the start. So I guess, Farhan, where does that leave us for questions, or are we?
So yes, we have ran a little over. I think that yeah, it looks as though people are leaving or might have other things as it is 12. So yeah, I'd just like to add, maybe we will take some of these questions and add a small note, or maybe add an additional slide if there's something that was missed. But I think you've covered a lot of it was covered very thoroughly in the slides itself. So thank you for that. Just a quick note to anyone who is still here, there's a little resources tab. If you click that, there is information about NEC Digital, our new online contract building tool that launched this week, and we're very excited for. I'd also like to thank the Orange Partnership again and Darren Ward and Ian Heaphy for providing such a brilliant second of our series of Assuring Costs webinar.
I think you need to give me 2 hours next time, Farhan. Sorry. I'm not
Or
sure.
maybe we have a separate one for a Q&A session.
Yeah,
Maybe have a particular Q&A one we could do.
Yeah, I didn't even
Yes.
get to lift my drink to have a drink.
Yes. But yeah, and thank you everyone for joining, all the participants from around the world. Yeah, thank you guys, and I'll see you guys for the next one.
Cheers. Thank you.
Thank you.
Thank you all. Thank you.